Okay, welcome everyone. We'll start our lesson 6. Today lesson will go through Lo6 and we'll do a bit, discussion on Lo7 as well. And last lesson will be our assignment discussion. So please make sure you will attend. And if you have any question, you can drop me email on ukversity.co.uk. We'll start. Okay, so today lesson key focus will be our Lo6, which is learning outcome 6, and we'll do a bit discussion on Lo7, and Lo7 will be carry forward on next lesson with assignment discussion as well, because it's quite, the things, investment appraisal strategies, which we'll go through in the next lesson too. Okay, so Lo6 is be able to review the techniques to manage global risk. What is a risk? Risk is a probability of happening something. So please, in business, always we use the term higher the risk, higher the return. So if you have a risk factor, higher the beta, what is the risk? Risk is a probability of happening something. Risk is a probability. So we can use in business beta. If you have a higher the beta, so higher the beta, higher the risk. So high risk, if higher beta, higher return. So like think about Amazon. And if you compare to eBay, so eBay, Amazon beta is 1.25. If you look on Google Finance and type Amazon and look the beta, you will find, the beta is 1.25 and eBay beta is 1.75. So eBay's beta is a higher, so eBay give you high return. So if you look EPS, earning per share, yes, what is the EPS? Earning per share in business. So always we need to be look around. So higher the beta, higher the return. Can we increase the return and reduce the risk? That's other question. Can we increase the return and reduce the risk? Yes, we can. Diversification. If you diversify, don't put all egg in one basket, and you look, some company, those have a high risk, some have a low risk, and you can look around, and divide your investment accordingly so you can minimize your risk and maximize your return. Okay, to measure the risk, we use standard deviation. So we can look around how much deviate from, yes, 1 point to others. So that's, we can look around from the mean, and that's, which we can, in the next, during assignment discussion, we can demonstrate on these points as well. That's, the key our learning outcome is focus on risk and return. Okay, managing, how we can manage the upside of the risk. Okay, risk is, a lot of people think is a bad thing. Risk is a probability of happening something. It can be good, it can be bad. It's not always risk mean the bad. Those people take high risk, they expect high return, but you have to think about how much risk you can bear. Focus the risk management has the preventing loss. Yes, however, the recent organization viewing the risk management in a different way. So we can look around risk seen as an opportunity to be seized. Yeah. Organizations are accepting some uncertainty in order to be benefit. Whatever we do in life, we have some risk. So we have to make sure, we manage the risk. So risk management is used to identify the risk associated with the new opportunities, increase probability of the positive outcome, and maximize the return. So effective risk management is seen as the way to enhancing the shareholder value. So if the company is investing in any new project, so we can look around, every business should be focused on maximizing the return of the shareholder. Wealth maximization is a crucial. Risk management is a process of reducing the probability of the adverse consequences. Yes, so you always have a contingent plan in place. So when you look the risk management process, always look the risk identification, risk assessment, risk planning, and risk monitoring. List the potential risk. Prioritize which is a high, low, medium risk. Yes. So we can use it risk, red, amber, and green risk is. So we can prioritize it, which risk is high risk, low risk is. So we can use it risk. Okay, when you do the risk management, always look to be explain the following risk identification. Identify the key stakeholder. Risk must be obviously identified before they can be managed. Risk assessment evaluate according to the likelihood of occurrence. So what is the likelihood of the rain? What is the likelihood of your investment you won't be successful? Always measure it. Risk planning, yes, planning is means set nav. You always do the risk planning. You have a risk planning register. If you don't have a risk management register, it's mean you just like you in the middle of the sea and you don't know the nav which way you go. So it provide a set nav, huh? So contingency planning involve you establish the procedure of the recovery of the adverse. You have a second plan. If what happened, what so we can look around risk monitoring. Always monitor the risk regular basic and do the risk reporting as well, huh? That is crucial in the business management and finance as well. So Tara and Sarah, these are the two approach. What is Tara stand for? T is a transfer or share risk. Like, when you're getting the insurance, it means you transfer risk to the insurance company. Avoid risk, avoidance. Yes. If you don't do anything, you're avoiding the risk. Yes. Acceptance, you have to make sure risk is up acceptance level. Yes, you have to risk reduction so we can make the strategy to reduce the risk, huh? So then we can these all being explained in some circumstances risk can be transferred wholly in the part of to third party, and adverse event, and the third party suffer the most. We can look around like insurance company, like health insurance and various other insurance in a business. So we can look around how we can transfer. Risk is can be probability, as we said earlier. Risk can be shared. Yes, organization might be joint partnership, joint venture, merger, acquisition. These all the strategy. So always in a global business, think globally, act locally. Like think about McDonald, always do the business throughout the world. They think globally, act locally, always understand the culture of local. That's a help you to minimize the risk. So if you don't, avoidance risk, an organization might choose to avoid risk together. However, risk are unavoidable in the business venture and they can be avoided only not to investing in that or not doing the any particular activity. That's which we can look around. Okay. Third strategy is reduce risk. Either the limited the exposure, particularly in the area of attempting or decrease. Like if you have a wiring and you need to be in a business, you need to be think about all equipment are tested. Like pad testing and various other testing. So you have to do the risk reporting as well regular basis. Risk minimization where the control are implemented. Control mean the corrective actions. Yes, if you have a flip and trip and anyone have injured, you have to be a risk registered and it won't be happen. You have to identify the causes of the risk. If you don't do it regular basis, create a big mess, in our organization. Risk pooling, yes, risk can be pooled. Risk can be many different transaction items. It's pooled together and each individual transaction and the potential upside of treating all the part of the same pool. Yes, so we can look around asset, we can look around the liability, we can look around different types of asset, we can look around different types of liability, we can look around the leasing, we can look around the credit, sales, and our credit management system need to be appropriate. If you don't do it, that's is we need to be make sure we'll regular basis will carry on doing. Otherwise, it can create a quite uh, quite mess in our organization. So that's as a good managers always. What is the management? Management always create a surplus, always try management is a process of designing an environment to achieve the pre-selected objective. As a manager, you have to design an environment to be achieved. So we in the management will say 2 plus 2. We want to make 5, not 4. So we want to create a surplus. So always managers is a critical thinking. So always carry on reflecting. So risk is a situation where hedge. What is a hedge? Hedge is, and again, the foreign currency fluctuation. We can hedge. We can get the services of hedge funding, hedge, to protect, and again, the foreign currency. Don't do the business in one currency. You can do in multiple currency. That will help you to minimize the risk as well. Okay, so hedging is mean reducing the risk. You can get the hedge service from the bank and you're paying the lump sum fees, and that's, is quite crucial to neutralize and reduce the risk. Okay, then always you do the risk mapping strategies. Always look, so like, we can use the various risk mapping. So you can look around the impact and the consequences, low and high risk, how you can reduce the risk, how you can avoid it, you can accept it, or you can transfer it. What are the probability of these, each of the area? So we can make, the plan accordingly. Yes. Okay, like some people invest in money in the Bitcoin. So it's a high risk because it's linked with the people's sentiment. When the people's sentiment is a high and everyone is going that direction, of course, the people, those are enter first, they can gain and other will lose because due to the high. As the passage of time with the sentiment people drop, it's everyone bearing the risk, of that of the dropping, which is, the $12 a coin in 2012, and it went up to in September 2012 when I start teaching, investment in security, that subject, and we did research on it and we found it went up to $18,000 in September 2020, and this went up in December 2020 up to $38,000, and suddenly it jumped up to 52,000. You will see it's big jump. It's mean is a big increase. It's a mean a high return there, but it's a high risk. It can go up down to it went down again. So it's a high risk, you have to reduce, Then in business, we always think about, various other model which we can explore more in our assignment purposes. Of course, it's not through your part of the syllabus. We can look around the weighted average cost of capital. If you want debt and equity financing, either you borrow money through issue the shares or either borrow money through investing or yes, so debt is always cheaper than equity. So if you have a high debt, if your gearing ratio is more than 52%, so high risk is you can expect, high return, but you need to be think about it can be liquidate your company. So that's, have a weighted average cost of capital, which we can look around how we can reduce the weighted average. You can change the proportion, and according to various authors, it have a demonstration that debt is better than equity, because on the debt you can save on the taxes, because that all interest you're paying on the debt is a part of expense in the business. But if you have a equity financing, you have to pay the dividend after the tax, to the shareholder, and shareholder expect. Okay, so we can look around dividend growth model. We can look around, capital asset pricing model. These, quite crucial. We can look around cost of equity, and these, the graphs we can use in our assignment. I'll further, give you the links during our assignment discussion where we can look around. Okay, next we have a discussion. We not go through the in details today because that we can link to the second hour. Our next lesson is the assignment discussion session where we'll go through our LO7 as in assignment discussion. We have 7 LOs. So financial management is concerned with the efficient acquisition and deployment, both short-term and long-term financial. Decision making is why I mention you selecting the best course of action. Always any decision you want to make, write down all the option and select the best option in the way of the cost and capital analysis. So that help, to reduce the risk. Okay, so we can look around the different sources of finance. If you make the decision, always look around what is the purpose of the finance we have. And then always you look around how we can maximize the shareholders wealth maximization. And yes, shareholders value increase, goodwill of companies increase, ultimately. So I copied the link here, is the Kaplan link, please. It's quite good for your background reading, to maximize and enhance your understanding in the subject area. That is quite good. Growth and the market share and social responsibility, corporate social responsibility. We can look around payback period, discounted payback, net present value, internal rate of return, and sensitivity, break even analysis, and ARR. These are all investment appraisal. Appraisal means checking the performance. Is it that the investment is good for the business or bad? That's, like £1 today is more worth it than £1. If you lending money to somebody, actually they pay you same money back. It's morally, ethically is correct, but in the financial world, every day is losing is a value of money. So always look around. Payback period, what you invest, what you get, and how long will. Always shorter payback period is a better, and always in a business that will help you to reduce the risk. So this method is easy to use. Assist to with the cash flows, but this method is not considering the time value of money. So it has own advantages, and it's only calculate up to the payback period. That we have included some example in the next slide. So that example, that's example, that's example will be here, which we can look around. You will see here we are investing 3100, we are getting 1900, 1800. So it's in our money which we are investing 3100, we are going to cover in 2 years, and we need to look around in the third year. We are looking to get 800 pounds. So sorry, is 3 years, and someone end of the 3 years is only 400 pound is outstanding to cover. In year 5 we are getting 500, which is higher than the 400. So outstanding amount divided by the following year inflow time by 12, we can calculate it. This project will takes 3 years and 10 months. So if other project will give you 3, so 3 is better than 10. So these, investment appraisal, we can use, different method in our discussion. So please, I'm not going through the next method, but you have to do a bit of research. NPV, net present value method, which we can look around the pros and cons. It's directly with the wealth maximization, which we'll go through time value of money. Yes, discount factor, that will go through 1 divided by 1 plus R, which will go through discount factor, or we can use the table. And next lesson, I'll go through the investment appraisal method, and I'll go through ARR. So please, you can do the background reading. I included the slide. There is a purpose you can, and try to attempt this quiz, please, at the end of the lesson. This is quite good too, and that will help you to enhance your understanding. Thanks for listening and attending today's session. Hope so. I'll speak you during our next lesson when we'll do assignment discussion. Thank you. Bye-bye.